2020, and thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Wilms. I'm president and CEO of the Milwaukee Company, and joining me as always is my cousin Mike Wilms, who is our Chief Operating and Compliance Officer. Good morning to you, Mike. How are you?
Morning, Andy. I am just fine, thank you. Hopefully everyone else is having a great morning.
So far, so good. Before we get talking, I want to remind our audience that nothing in this podcast should be construed as investment advice, and the views expressed during this conversation represent Mike and my personal views and not those of the Milwaukee Company. And with that said, I'll lead off, Mike, if you don't mind, with a recap of the market since we last spoke. Stocks fell on Thursday, as we all know, retreating from all-time highs as tech, the market leader since the rebound began in March, suffered the biggest drop in months. The Nasdaq fell by 5% on Thursday, demonstrating that momentum can in fact go both ways. By week's end, by the close of the market on Friday, the S&P was down about 2.3%, the Dow was down almost 2%, and the Nasdaq had dropped for the week by 3.25% for its worst week since March. Of course, we all know the markets were closed on Monday, so nothing to report there, but the stock market did continue to fall yesterday as investors continue to take profits on shares of the mega tech companies that have been the top performing stocks this year. Over the past week, the S&P tech sector fell by more than 10%, which meets the technical definition of a correction. But we have to keep in mind that even with this recent pullback, the Nasdaq is up more than 70% from its March bottom. So even though we've had a big correction, it's really not all that major in the big scope of things when you put all the gains in there, and that also means that further drops are not out of the question. And whether or not,
the one thing that I would interject, I thought this was kind of interesting when they were talking about those performance numbers this morning, with the Nasdaq being down to 10%. It's the fastest 10% correction in history, where it happened over just 3 days.
Yeah, that's remarkable. They lost. I heard that in total, the Nasdaq lost about $1 trillion, but it's still up $2 trillion since the. So one step forward or two steps forward, one step back, I guess. But we really don't know how far this drawback is going to be. I mean, obviously these tech sector areas are suffering in part because people are starting to wonder how much longer this coronavirus is going to be helping some of these companies like Netflix and Amazon. And that really depends on how this coronavirus plans out from here. Do you have any insights on that you can share with us, Mike?
Well, we're going to shift into the coronavirus. I mean, there's been, I think the most front and center piece of news here in the last day has been the pause in the AstraZeneca Oxford University trial, where there was an unexplained illness, and this is a standard procedure to pause a trial when there's a safety signal from one of the trial participants. There's questions about how long the pause is going to last, whether it's going to be just a couple of days or a couple of weeks. Expectation is for AstraZeneca and the doctors and scientists involved to fully explore the cause of the safety signal and make sure that continuing the trial is safe for participants. And this is something that you see in all clinical trials. I mean, if there's a safety signal, it's paused. It's not going to have an effect on any of the other 30, 40, 50 vaccine trials that are in process. But there's been a big focus on that particular piece of information.
Yeah, I think. Go ahead.
Go ahead, and you seem to know a little bit more about the actual nature of the safety signal.
Well, what triggered it was one of the participants came down with transverse myelitis, which is inflammatory syndrome that affects the spinal cord, and it is oftentimes sparked by viral infections. For example, we see this with people sometimes who have MS. It's a kind of thing where your immune system is what triggers MS and can cause this to happen. It is something that they were aware of as being a possible consequence of coming down with the COVID-19. It's also something that's very rare. So the fact that you would even have one participant in the trial come down with this rare disease is of consequence when the virus the vaccine they're trying to develop works on the immune system, and this is an immune system disorder. So I think it's a serious reason to be concerned. But as you point out, there's now more than 100 vaccine candidates being developed around the world, and 36 have entered human trials. So while this particular vaccine, which I think really was considered the leader up until this point, has had to put a pause on it, it doesn't mean that we aren't still making great progress. I think we certainly are. And I think, Mike, you were talking to me earlier before this broadcast about the Novavax. It would now kind of come into the lead in terms of the most promising vaccine.
Correct. And to your point, there are a large number of additional vaccine trials already in human studies, and the Novavax vaccine, to this point, it has just been on 131 patients, but all have developed antibodies, and some of them at a amazing 4 times the antibody production for someone that actually had the virus. So, yep. Everything is the medical community is trying to find a solution to the problem, both from a vaccine and therapeutic standpoint as quickly as possible. The other thing that I would touch on here is that for the last 3 days, the number of new reported cases has been under 30,000. Day before yesterday was actually under 25,000. Today, slightly over 26. And the real key question there was a lot of concern about potential spike in infection rates with social distancing going out the window with the holiday festivities here from the last weekend. So, I mean, that's something to keep an eye on. Absolutely.
Well, thank you for that, Mike. Let's talk a little bit about what's gone on with the economy as of late and some of the leading economic indicators. There's still hints that the recovery may have lifted the U.S. out of the recovery that had lifted us out of the recession is now at the risk of faltering a little bit. And the biggest warning sign there is the employment. Private sector jobs continue to increase. That's the good news. But the bad news is they're increasing at a slower rate than you would expect at this point of a recovery. The Labor Department said Thursday that the number of first-time filers for unemployment totaled 881,000 for the week ending August 29, which is, under 1 million for the first time in a few weeks. And the unemployment rate dropped to 8.4% in August, which is by far its lowest level since the pandemic led to a shutdown, and it was better than what the Dow Jones estimate I think was around 9.8% or thereabouts. So, but in total, even though those numbers were quite encouraging and better than many people were expecting, in total, there's still less than half of the jobs that have been lost or replaced during the virus have been recovered. So we're still have a very large amount of job loss. And in an interview, in that context, in an interview last week, Fed Chairman William Powell made clear that he does not think we're out of the woods yet. To the contrary, he made perhaps his strongest statement yet that the Fed's willingness to pump money into the economy is almost unlimited. And he said, well, I'll just quote him. He said, "We think that the economy is going to need lower interest rates, which support economic activity for an extended period of time. It will be measured in years." So the Fed's doesn't look like it's in the mood to scale back any of the stimulus that it's been pumping in. And then just yesterday, I think Senate Majority Leader Mitch McConnell said that the Senate does plan to vote on what he called a targeted coronavirus stimulus bill as soon as this week. Now, he didn't really get into the specifics there. Maybe you know more about them than I do, but I couldn't find much on the actual specifics. But I know he said it would focus on healthcare, education, and the economy, and it's expected that the plan would include a $300 a week in supplemental unemployment benefits. So apparently Congress isn't done either, pumping money into the economy.
Well, and that, it's an interesting question. I saw some numbers this morning about the total proposed Senate package ranging between an additional 500 to 700 billion. And interestingly, Chuck Schumer on the Democratic side had indicated that he thought there was a real possibility of getting something passed at the Senate level. And they did have Ted Cruz on CNBC this morning. And, he was kind of trying to politicize the whole debate, but he also felt that the Senate would get something passed. The big question is, there's such a chasm between the $3 trillion in the House versus even at the upper range, 700 billion in the Senate.
Very good. All right, so with all of those wrap-ups being completed, let's talk a little bit about some topics that have caught our eye during the course of the prior week. And the first thing I'd like to ask you about is this recent pullback. The Nasdaq has fallen by 10%, we've talked about, and one of the drivers that's being suggested for this recent pullback has been the options market, which is kind of unusual. But I know this is something you're interested in. Why don't you fill us in?
The focus around the option market, it's really pretty amazing. They track how many option contracts are outstanding, and the quote-unquote open interest had gotten to millions of contracts outstanding versus something in the 200,000 to 300,000 contracts outstanding in some of the large tech names. And there was a news story towards the end of last week where SoftBank, the large $100 billion investment fund over in Japan, was identified as a $4 to $5 billion purchaser of additional call options, which you purchase a call to speculate to the upside in a particular security. And if you purchase the call option, the description of an option, it's a securities derivative. So there needs to be a buyer and a seller simultaneously. So if you buy one, somebody needs to sell it to you, right. And that selling individual is going to hedge. And the way that you hedge a call option is to buy the stock.
So you had all these people buying stock to hedge the options that they were selling, which obviously created a lot of upward pressure.
Exactly. And then, as that upward pressure started, from a large institutional player, people pick up on the additional activity and they start blogging, and then Robinhood and the retail side gets in, and the 4 or 5 billion of options purchased by SoftBank were dwarfed by the 40 or 50 billion of additional money that came in elsewhere in the market.
Right.
So,
but the problem is, of course, that can't last forever. So people, once a lot, I think, you correct me if I'm wrong, but I think what might happen is other investors saying, wait a minute, this is all being driven by options, not by any underlying fundamentals. And so ultimately, when that became well known, people who had made money in it said, this isn't going to last forever. Everybody started selling before the bubble popped, so to speak. And we've seen this 10% correction as a result. It probably reminds you a little bit of your days back when you were living in Chicago, huh? And working at Oppenheimer doing all this kind of trading.
Exactly. And it's very similar to the .com bubble, where you had irrational securities valuations and massive option trading around stock moves that weren't based on fundamentals. So, unfortunately, we've seen this before, and the song just doesn't end well.
Not usually. And, this is really, there's two ways to use options, right? You can use them to make a fast buck. You can make bets with options. That's the way a lot of people use. That's all what we're talking about here, right? This was option trading to try and make a bet, or you can use it as a way to hedge, where you're not trying to necessarily make money on the option itself. You're using the option as a protection against the market going against you. And Milwaukee Company does the latter. We never engage in the former, but we were able to take advantage of this, situation to close some of the hedges we had in place. And so from that perspective, it worked out well in terms of the protection we had acquired. So, all right, well, let's move on to the next topic, which I'd like to talk a little bit about what Chairman Powell and other members of the Board of Governors, I mentioned how they're planning to continue to stands ready to add money to the economy as long as they feel it's necessary. And, what that really creates keep interest rates lower longer, I guess is what I'm trying to say. They really made a firm commitment to that. And to me, we've talked about this in the past. That raises some serious questions about the role that bonds play in a portfolio, because historically, we of course invest in bonds because they provide ballast to a portfolio, and they have been less volatile than stocks and tend to move in opposite directions. But we also, have been investing in bonds traditionally for income. People want to collect the interest income on the bonds, and in some cases, people invest in them in hopes of making capital gains, on selling bonds that they bought before they mature if interest rates come down. So, with interest now, with the yields moving close to zero, the traditional diversification that bonds have provided in the past, could theoretically fade and perhaps go away completely for several years. So that has a lot of people saying, and you hear a lot of commentators talking about the possibility of, or advising people that the 60-40, 60% stocks, 40% traditional portfolio allocation may be time for that to come to an end. And you should be getting out of bonds because there's little opportunity for capital gain, they argue, and the income isn't worth what it was. The yield isn't what it once was, and there's other ways to get the diversification benefit. And I suppose if you're one of the brave few who can just, never look at their account and stay with an all stock portfolio, even when the market crashes, and if you're down 40, 50%, you say, well, I don't care. I'm going to ride it out. That may still make sense. It particularly may make sense if you're investing through a retirement account, because people don't tend to pay much attention to what goes on in their retirement accounts, and they usually have a very long horizon. So that could be some sense, but I don't think it's, I'm still not willing or prepared to give up on bonds in the role of a portfolio. I think it may be more sensible to just reconsider how you use bonds in a portfolio, and to maybe take put on some protection to make sure that the damage is reduced if interest rates do in fact rise, and you want to try to minimize that damage. And of course, as you know, Mike, because you're very involved in our bond management, one of the ways to do that is to shorten the term of the bonds that you hold to maturity.
Correct.
So, and there's been a cost to pay for that up to this point, right? Because interest rates haven't gone up. So if you have a shorter term bond, you get a little less interest. But the difference now has gotten a lot closer than it used to be. So I think keeping on what they call the shorter end of the yield curve, it makes a lot of sense. And the other big thing is to make sure you plan when you buy a bond, to make sure you plan to hold it to maturity and not invest in bonds for the idea of capital gains at this point. Because if you do that, you're going to get exactly what you planned on getting when you bought the bond, assuming they don't default. You're going to get exactly what you anticipated. So it may not be what you'd ideally like, but you won't be unpleasantly surprised. And when interest rates are lower, we've talked about this several times, bonds get more risky to own, right? Because if rates go up, you can lose a value of the bond, market value of the bonds. So if you have more risk in the bond side of your portfolio, it might make sense to scale back the risk on your equity side of the portfolio. What do you think about all this, Mike?
Well, I mean, you covered a lot of ground there. So
yeah, sorry.
The first thing that I would point out is the discussion about duration and shorter dated bonds that mature sooner than later, and the difference between a short dated bond versus one that matures further out in the future. Right now, short interest rates are the Fed is targeting 0 to 25 basis points. That's why everybody is struggling again with 1 basis point in their money market fund return. And, fortunately, there's a little bit more slope in the yield curve, meaning longer term rates have moved up here a little bit. But at the end of the day, the biggest problem is inflation is still in excess of 1%. And the 10-year Treasury is at essentially 70 basis points. So you've got a negative real return. Mm-hmm. That's one of the things that you need to keep in mind. Your purchasing power could be negatively affected at these low interest rates.
Right, but it could be. It's still. I mean, that's true. And if inflation stays where it's at, and your bonds are yielding lower, you will have less purchasing power at the end. But then again, better to lose 30, 40, 50 basis points. It's 0.5% in purchase power. Then you could lose, like these guys,
30% in your equity portfolio.
Yeah, 10% in 3 days, right? So you got to be careful how sometimes you just have to play the cards you're dealt and stay the course. And personally, in my mind, it's probably still an important part in most people's portfolios. But Mike, I'm going to go a little off script here, and you mentioned the money market funds, and you and I've had discussions about the fact that people aren't, the money market funds risk breaking the bank, so to speak. And I got to be a little careful about that, where you park your money market funds. You want to talk just a tad on that?
As we came out of the financial crisis, the Federal Reserve provided insurance, essentially against breaking the buck on the money market funds that held simply government securities. So they're going to be the lowest returning, but therefore the least risky investments for a money market fund. The money market funds that invested in commercial paper issued by corporations, or a type of financing arrangement for investment banks called repurchase agreements. The money market funds that own those type of securities didn't get the benefit of the insurance, you saw a big drop in commercial paper issuance by corporations coming out of the financial crisis. That's starting to come back a little bit. So you need to be careful to make sure that the money market funds that you're investing in are based on government securities and don't have the potential of breaking the buck.
I think that's some really good advice, because most people, money investors, just figure, well, it's a money market fund. Is a money market fund. I'll take the one that's the best yield. And in many market conditions, that's okay. But right now, there is the risk of breaking the buck, and so you got to be a little more careful. And you have to look at what the underlying investments of your money market fund is, because it is critical at this point in my mind. Well, Mike, I guess that's going to be enough for today, because we're getting a little long on time here. So I'm going to wrap up the conversation. I must compliment you on your restraint. You didn't give me any grief about dressing more casually today than I normally would with my Packer attire on. But with the start of football season right around the corner here, I felt it might be a little appropriate to let everybody know where I stand on the matter. So,
well, being a good Wisconsin boy, I think everybody would expect you to be a staunch Packer fan.
I guess that's probably true, but I wanted to make sure there was no doubt. So on that happy note, I'm going to say go Pack. Thank you all for joining us, and keep in mind that you should not act on anything you've heard in this podcast until you have discussed it with a qualified financial professional who's familiar with your personal situation and investment objectives. And on that note, I'll say have a great day, Mike, and all of our listeners, and we'll be talking to you again soon.
Have a great day, everyone. Bye-bye.
Bye now.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.